Hello, everyone. Welcome along to today's information session on the Algorithmic Trading Certificate. My name's Jeff Brown, and I've basically been involved in various educational programs for the last 20 odd years, including the likes of obviously the CFA, the FRM, the CQF, Kaya, and a lot of these kind of programs. I genuinely think that the ATC, and hopefully you'll get a flavor of this during the course of this information session, I think the ATC is in a league of its own in terms of the practicality of this program. It is incredibly useful. And we've got the two lead lecturers of the program, Nick Ferruzzi and Brian Healy, who are going to be telling you all about the program, breaking down the syllabus of the program, explaining why it's beneficial in practical terms. And just to give you a little bit of an introduction to them, so Nick is, he's been here and done it for a very long time. He teaches at UCL. He's been heading up desks in the financial services sector for many, many years. He's worked at the likes of Citadel, Nomura, Goldman Sachs, Deutsche. So he is a real expert, a genuine expert in this field, with a quantitative background, which is obviously essential for this kind of topic area. He's got a PhD in maths from NYU. And Brian, similarly, Brian Healy is an algo trading expert. He's, again, been in the financial services sector for many, many years, heading up very senior positions, heading up big desks at the likes of Citi and Deutsche and Barclays, teaches at UCL as well. In fact, he was educated to a very high level at UCL, at Cambridge, Stanford, NYU. So you're in very, very good hands. And I hope you find this information session incredibly useful. And I hope that by the end, you've got a really strong sense of what kind of experience this will be going through the ATC program. I'll hand you over to Nick and Brian.
Hi, this is Nick, and thank you very much, Jeff. I think Brian is probably in the process of getting the slides together because he's going to be serving the slides. But I should just, just in part of introduction, this is an outcome of a course that initially I'd been teaching, and then brought to UCL. I've had I don't know, some over 500 students take the course in some form or another. Brian separately is an expert in this area and someone I wanted to join up with for some time. He teaches a class in he teaches various classes in machine learning at UCL, and we thought that bringing the two together was a very practical way of moving forward, because the attempt is, unlike the syllabus that we offer at UCL, it's meant to be something that's very practical. It's meant to be something that has that for those with a direct industry interest in the industry, and oftentimes with experience in the industry. But with that said, I'll see if I know Brian was planning on sharing the slides, so let's see what's
ready. I'm ready to go. Just do it right now. Does that look okay?
Yep, it's good to me.
So ready when you are, Nick.
Okay. Well, I can't remember what's in the slides right now. We've taught it now. I think this is our fourth cohort online this time around. This practitioner's guide version of the course, and as I said, I should maybe can skip to the next slide. So I guess, as I said, The course was an outcome of something that initially I was interested in this because I'd done a number of different jobs in mortgages, in swaps, and relative value, in emerging markets, and in 2013 I moved back into a purely quant role. So one where I was actually designing strategies. And what I found was that although most people didn't know that there was a statistical underpinning or a sort of a model-based rationale, theoretical rationale for most of these trades, that there was actually quite a lot of academic literature out there. So as a consequence, I started putting it together and created a PhD course out of that. And since then had a few PhD students in this area. Most recently, some doing mid to low frequency, then mid frequency, and then recently high frequency. But recognizing that there's a tremendous amount of good material that is easy enough to access as long as it's put together in the right way. And our attempt is to put it together in a way that makes it very appealing and easy for you all to be able to access the material, to know how to go on and move forward in the industry. So, Brian, I
just skipped the introduction. I think is probably.
Yeah, probably. There we go. Oh, there we go. Brian, why don't you go ahead? I've waffled for now. Enough.
So, I mean, it's just as you're all here, so you probably have some idea what to expect. What is algorithmic trading is one of the first questions we often get asked, and it probably depends a little bit on who you ask, but the way we define it is that it's any trading which relies purely on mathematical models and algorithms. So there's as little human kind of intervention in the actual process of trading as possible. So the process of creating the algorithms, fitting the algorithms, doing all of that work obviously requires quant skills, data science, lots of other skills, programming skills. But then once the algorithm is up and running, it should be as automated as possible. And as markets have become more automated, you don't really need to spend too long reading any financial media, financial press to realize that algorithmic trading is, I won't quite say taking over yet, but it's becoming a bigger and bigger slice of the overall trading landscape. Sometimes we hear terms like e-trading and so on, and it covers a lot of the more high frequency trading. Now, that's not a particular focus of this course. We touch on it, but it all comes under this kind of algorithmic trading umbrella. Now, we have some numbers in the course, for those who are interested, and any book will tell you as well. That's reasonably recent. The percentage of volume, percentage of flow on the exchanges that's generated by essentially machines, is huge. It's growing growing all the time. So the discretionary trader is gradually being squeezed out of most markets certainly in terms of volume, and clearly humans can't compete in terms of pure speed. The algorithms can be used from everything from generating signals. So there's lots of different aspects to trading. You've got a signal, then you've got to act on that signal somehow. You've got to execute trades. You've got to book them. So there's lots of different steps that can be automated, and it all kind of comes under algorithmic trading in a sense. People will argue which is the important bit, but it's all part of the process of coming up with an idea, executing it, booking it, risk managing it, etc. Some quant funds have been heavily algorithmic from the very beginning, going back 30 plus years, many of which you'll know, like D, Show, and Renaissance, etc. Others have become more, I think every fund actually has become more algorithmic as time has gone on. Some of them have gone from being completely non-algorithmic to being almost completely algorithmic, and others are kind of somewhere on that journey. But I think it's probably fair to say nearly every fund of any size now has an algorithmic offering.
Yeah.
And some shops, some places automate absolutely everything. I think that's probably still a little bit rare. I think a lot of places still have some parts that are not fully automated in the entire process. But again, the direction of travel is absolutely clear, and that's why we're all here.
So can I just add on that? I mean, there is increasingly, of course, there are discretionary shops that use algorithmic elements for execution, and as well there are shops that would market themselves as algorithmic. Many of which it depends entirely on the market, but in the highly liquid markets, that could be algorithmic end to end, decision to execution. But then there are some that, because of the nature of the markets that they're trading, that there's no electronic execution. There may be actually a voice trade at the very end who actually picks up the phone or asks for an RFQ from the counterparties and then executes based on that. So it's algorithmic trading has, as I say, it's increasingly from decision to the execution, but sometimes there are different parts of the process that are automated, and as Brian said, increasingly there are more that go into this area.
Okay. So our next section then is sort of who, what, why this course. So who's it for, what's it about, and why this particular course. So do you want to start with who's the course for, Nick?
Sure. So this is meant for discretionary traders and risk managers, people who have some experience in the background. They understand the mechanics of markets, and they already know to some extent how things work. But this is to go deeper into the mechanics of how markets work, and developing the tools to devise and manage new improved algorithmic strategies. So we've worked with quite a number of discretionary traders before, who actually know about putting on trades, know about how to have an idea about how to size them and things like that. But we go through and we explain how it's typically done in practice, and some of the theory behind giving them tools to run with. We've also had algorithmic traders and quants join us, those who are PMs who have their own algorithmic process, but recognize that there's room to learn, room to improve, as well as quants. Oftentimes, quants have there are different types of quants in the industry. There are those who are more sort of pricing quants, who work with structuring teams and pricing teams and risk management. But then there are those that are working specifically in e-trading or algorithmic trading, and oftentimes quants want to move from one to the other. So appreciating the e-trading, the market focused rather than pricing focused, I'd say more statistical rather than stochastics, is one of the things that we want to sort of impress upon people. And as well for graduate students and students in data scientists. People come from slightly more outside the industry who want to know our courses, in some sense, you could say somewhat finishing for those who have, who say, for instance, had a quant finance background. Oftentimes they don't touch on these matters in a very serious way. And we go through in great detail on how to use statistical method to work on I'd say typically it's low to mid frequency trading, but we'll touch a little bit on high frequency as well. So yeah, I guess I told you, Jeff, of course, said a little bit about me.
So we probably don't need to bore them with this again.
Yeah.
By the way, you will be getting a copy of this deck afterwards, so don't worry. Certainly don't take any notes.
Yeah.
The goals of the course then are, what are the goals of the course? Is to first and foremost provide you with the fundamentals of algorithmic trading, basically. You know, what it is, what tools do you need to do it, what techniques are needed, the fundamental skills that everybody needs in order to build a strategy for themselves. You learn about data, which is all important in this industry, where it comes from, how to clean it, what sort of issues you'll face, how to work with it, and a little bit about how to find alphas. Of course, and that's something that ultimately you will either know a little bit about already, or you will develop over the course of your career. It's not something you don't come to this course and we give you a list of alphas that you can go out and make a ton of money with, straight away. It's all about how you find them. So it's, teaching you how to fish, as it were. Then we give you practical experience. So we show you how to apply what you've learned. And that's particularly in the sort of final assessment, is in the form of actually developing a strategy yourself, which we'll come to momentarily. But throughout the course, we really emphasize the kind of the hands-on aspect. We have a GitHub repository, which you'll all have access to with all the code. And that will remain with you, even after the course finishes. We're gradually building up material in a wiki as well, and other kind of repositories where we sort of store lists of papers, books, and so on. So by the end, you can build a strategy which is efficient, scalable, and that you can test. You can show that it works. You can demonstrate, information ratios, however you wish to kind of show that it's a good strategy, and you will know how it's roughly how it will compare with the rest of the industry, right? We don't consider obviously every single strategy, but what we'll say is, roughly speaking, a strategy like this, you will expect this sort of performance, etc., etc. So you will have a very good idea of where you sit with respect to everybody else. Do you want to do why, Nick?
Sure. So we hinted at this before. It's a fully revised version of the course, Algorithmic Trading Strategies, which I've taught at UCL, to the computational finance and risk management PhD and MSc students from 2016 actually until now. It's a course that I nowadays there's such demand for it. We have to turn people away at about 110 students. So not only is it fully revised, you get our attention, which is something that's a little bit scarce when it comes to the UCL course. There are over 500 students who completed an earlier version of this course and found the material useful. I was just chatting with old students who have since worked in high frequency trading, work as quant research in quant funds. And there's plenty who've sort of used the same material or working with or using the fact that they worked with us to move forward, and found it very useful. The course is a hands-on approach, building trading pipelines from data to futures to modeling to allocation and execution, and it will tell you all the different steps of it, as well as where sometimes people will do a shortcut. But the fact is, all the different strategies can typically fit into a single kind of framework. This is the fourth cohort for the ATC, and as Brian says, we are amassing more material as time goes on, because we have so many things that we've yet to write down, but we've told people about in our ongoing online sessions. And I say that's one other thing to add to this, why this course is you get, during the course, aside from our recorded lectures, we have pretty extensive online chats and discussion with Brian and me, where students can discuss in great length, various of the things they're working on included. And we bring our experience to bear on that, as well as how it would potentially fit into a rigorous algorithmic trading pipeline. Okay.
So we're on to the syllabus. So I think there's we provide quite a lot of information in this actually, and it's more, I think, aimed at your sort of reading pleasure later on, but we'll sort of skim through it maybe and just sort of touch on the highlights, as it were, in each section. So the first week then is, well, as you'd expect, first of all, an introduction to algorithmic trading, the industry, who the players are, how it's sort of structured, and the different types of traders. Again, some of you may know this, some of you may not. The size and growth of the industry, which I just mentioned earlier, will give you some solid numbers on that, just so you can be completely satisfied that algorithmic trading is the where it's at, and where the growth is. And we start with some quite simplified frameworks, some simple approaches to strategies, and we look at some of the execution styles. You want to do week 2, Nick?
Yep, and then we move on to some practicalities, data, where you get it, what it comes from, how you can use it, and futures. There we go. One of the big sources for algorithmic trading, probably one of the first that was fully automated, was futures trading. So it's talking about all sorts of specific areas in futures here, and we separated out commodities, but it is actually commodities futures typically, as well as all the other different types of futures. Practicality of working with those kind of data sets. Then working on equities, how you handle equity data, how you handle the market data, fixed income as well, much more complicated, much more model based. But there's a fair amount of algorithmic trading there. And then we give, there we go, nicely organized, some light reading material, background books, all the different different reading material, which to be honest, it's good. This is not just a course; it's an introduction to a whole career, which is a potentially lifetime career. Oh, and then we move on. Yes, that's right. To after you have data, and you've sourced your data, what do you do with it? Well, of course, you create features out of it, and features have to be. And then features are a little bit more than data, because they're data with that has been processed effectively. And then you have a processing pipeline. You have to know how to deal with how to process it, to make it robust, to get rid of outliers, to get rid of missing data. And to save as well your process data before you can create signals out of it. And I think that week we also touch on signals and the various different more standard forms of signals, which are typically price based. But then there's also we move on to, so price based means like momentum and mean reversion and things of that nature, looking for patterns in data effectively. But then we move on to all other data sources, which sometimes are rather hard to put in. Can you skip to the next?
Yep. So in week 3,
that's next week. Okay.
Still with the kind of the fundamentals, in a sense, the basic building blocks you need. We look extensively at statistics and time series. It won't come as a surprise that much of the data we deal with in finance is a time series by its nature, and that presents lots of issues that you need to understand. So aside from kind of the basic statistics and probability that, again, some of you will be familiar with, some less so, we kind of do a refresher and all of that, and sort of show how it's all relevant and used in the world of trading. We looked at asset prices, so statistics, probability. These models are used really to describe asset prices as one of the main functions in our world. So we're trying to create models of reality. And then we look at some sort of facts and findings on asset prices, how assets tend to behave, how they don't behave, and what to watch out for. We look at things like compounding and discounting, those sort of nuts and bolts of finance, and probability, as I say. Then specific distributions that are kind of particularly relevant here. So, some of it won't be a surprise to you. Some maybe will be a bit less familiar. And then we look at maximum likelihood estimation, which is a sort of a general tool that's used quite a lot in the sort of the model fitting world. So whenever you're essentially fitting a strategy, trying to figure out what parameters to use, is one of the very important methods you need to know. Multivariate distributions, again, we're not always dealing with a single variable. Quite often we're dealing with a portfolio, we're dealing with multiple assets. So it's very important to understand things like covariance, correlation, and so on. And the general topic of statistical inference. So how do we make inferences about the market, about the world, from the statistics that we kind of extract from the data that we have? And doing that safely and reliably is obviously very important. And then the whole topic of time series, stationarity, trends, how to, the common models that we use for time series, such as autoregressive, moving average, etc. And then finally, we combine them into ARMA processes, and we look at things briefly. We look at things like seasonality and other issues, and then that leads to differencing. So how do we get rid of some of these issues? So how do we take the data that we observe in the market and create a series that's actually usable? And that's clearly very important and kind of step one in many tasks. And then maximum likelihood estimation. This is in particular for time series, gets mentioned here again. And then we just look briefly at some of the sort of the history of forecasting, what approaches people have taken, how that's kind of worked out, and so on.
Actually, just to sort of sorry, in between there and machine learning, and I know that everyone's convinced that deep neural nets are the next best thing for everything. But when we talk about it, we talk also about the benchmark for forecasting being statistical models, and sometimes adaptive statistical models, things like ARMA, ARIMA, even moving average models, but as well common filters and things of that nature. And that history of forecasting sort of ties them all together in some sense. It's only recently that machine learning models have started to outperform, in some cases, the statistical models. It's in financial markets, it's very much of a challenge, and that's why having a firm basis in statistics is really important before jumping into things like neural nets and any other kind of machine learning.
And speaking of which, the next topic is machine learning. Do you want to go through that next?
Sure. So machine learning, we'll talk about what is machine learning, the difference between supervised and unsupervised, and things like sort of the standards of machine learning. What is classification and predicting discrete label? That's for labeled data. And then we'll look into things like regression. Which is, as you say, it's a statistical method, but there's it's the basis for most machine learning as well. Then from regression, we move on to the sort of the most simple, the support vector machines, what their motivation is, how you fit them, how you tune them, and things like that. And again, SVMs are very closely related to they're a form of a kernel machine, and we'll talk about kernels in general, kernels including Gaussian processes, RBF nets, and things like that. And so we'll cover a whole great range of them in the discussion of kernels. From there, we go on to a slightly different version of decision trees, things like CART and random forests. How are decision trees made, sort of the greedy algorithms and the bias in the tree, but the bias being eliminated, the overfitting that can be eliminated through ensemble methods. And I guess that's probably in this section is a random forest. There we go. Ensemble methods and how they work, and how ensemble methods, you get a lot for free just by doing things in parallel. And then finally touching on neural nets and how they work. How weights are fitted, how what back propagation is, why to some extent why You have things like universal approximation theorems, but then why deep as opposed to just wide? So there's a touching on some of these things, to what extent they are really being used in the industry. And then finally reinforcement learning. Reinforcement learning, which is there's reinforcement learning is basically stochastic control, and in reality, you'd say that pretty much everything we do is a form of stochastic control, because we don't just want to forecast. We don't really care about forecasting markets. We care about what we're going to do in them. And that's what matters. What we're supposed to buy and sell, and how much of it. Those sort of optimal policies. And that's what reinforcement learning is all about. So this is really, in some sense, everything that we do is potentially leading up to this, although it is rare that it's used as its only approach. And I think that's the end of week 4.
Yeah. So week 5 then is trend following, which is the first of our kind of major umbrella groupings of strategies. So a lot of the most common strategies used out there are forms of trend following. And the name kind of says most of what you need to know, but there's lots of detail in how you detect trend, how you implement stop losses, how long you should hold for, etc., etc. Momentum is another kind of very similar, very closely related issue. Skewness, momentum, and trend following strategies have some nice properties as well, which we look at. Responsiveness is a big issue with any of these strategies. So how quickly do you detect the trend is obviously of paramount importance, and how quickly as well do you detect the trend has ended, so that you don't lose too much money. These are all very big issues. And cross-sectional momentum, so momentum across multiple different assets rather than just in a particular one. So we often think about momentum as being a single asset heading in a single direction, but it comes in different forms. And there are lots of other kind of issues around trend following momentum, which we go into, and there's not much point in dwelling on now. But a specific one, and Nick touched on this earlier, that a lot of trend following takes place in futures. So futures are large, liquid, exchange traded instruments, and they've always been very popular for trend following strategies. So there's a lot of, again, issues at the intersection of futures markets and trend following that we specifically look at. You want to do week 6?
Yeah. So week 6, we start looking into 2 other sets of strategies, which are actually very close related: carry and vol risk premium based strategies. They're both types of carry strategies, and carry strategies tend to work well when the world doesn't change a whole lot, whereas trend tends to work well when the world is changing. So we'll look at carry strategies first of all in foreign. We'll touch on foreign exchange and how carry works in foreign exchange markets. And then we'll talk about the carry trade in general. How does it work? How does it what justifies it? Carry is actually carry is for those who have sort of a fixed income background. It's the first thing everyone knows is carry, and where to find it, how to calculate it, and so on. So we'll go into some detail about where carry comes from, what kind of premium it is, when it works, and how can you use it to diversify. Then we'll move on to so it's the difference between physical and risk neutral measures, because carry is more close to carry is what works in physical measure as opposed to risk neutral measure. Now, those of you who know volatility know that you have to know how to calculate using risk neutral measures. We'll also be talking about margin and where because margin is, I say, close related as well, because margin and leverage are the 2 things that make strategies work much better than anything else. But they again, there's some sort of sense of stability that's necessary there. Finally, we'll move on to vol strategies, and there's types of vol strategies and things like the variance risk premium or short gamma strategies. We'll talk about how one makes money with those, what sort of risk return profile one makes with them, as well as other sorts of slightly more complicated vol strategies. The challenge with vol strategies, of course, there's so many of them, but finding those which are systematizable is sort of a primary focus here.
Week 7, then we look at. Oh, sorry, Nick, you finished?
No, go ahead, please.
In week 7, we look at mean reversion, which in a sense is the flip side to trend, where a market kind of reverts to where it should be or where it was, or in some sense converges. And there are lots of statistics here, lots of tests to figure out if pairs of assets or group of assets have nice statistical properties, which will mean that they mean revert. And co-integration is the sort of the watchword in all of this. We're looking for things that are co-integrated, and then we expect certain behavior from them going forward. How we implement mean reversion strategies. So there's issues that are not as much an issue with, say, trend strategies that are a big issue for mean reversion, and vice versa. So there's specific things that we need to think about. One aspect of mean reversion that's important is that when you trade mean reversion, in a sense, you're providing liquidity to the market. So in a sense, you're getting paid. Part of the reason you make money, or if you do make money, is because you're providing liquidity, and you need to be aware of that. That's what you're doing. Change point detection. I mentioned it when I'm discussed trend as well. This is where we need to figure out as quickly as possible when a trade is broken down, right? When the world has changed or the dynamics of the particular asset has changed. Something has changed. And again, lots of statistics, lots of kind of, good mathematics in there that are very powerful and useful for detecting that. Pairs trading, some of you will have heard of it, and statistical arbitrages are the more complicated version of pairs trading. It's really just a common implementation of mean reversion. It's basically generally done in equities, where you just take pairs, lots of groups of things, pairs of things, and we look at some of the original work done on that and how it's sort of evolved since. And you can't really talk much about equities without getting into factor models and to some degree PCA, principal component analysis. So how can you kind of reduce, so rather than representing 2,000 equities as 2,000 different things, can you collapse it down and represent it with 5 or 10 or 15 numbers or something like that, coefficients? Go ahead, Nick.
Yeah. So then week 8, we're trying to put a lot of these things together. So whereas we've talked about strategies, we've talked about mean reversion strategies, we've talked about, and some of these, some would call, and then trend following on momentum strategies. As Brian was talking about, there's some parts of the industry, they talk about these as being factors. In other parts of the industry, they're all they are is signals. They're features. They're features that you put into a model. So we talk a little bit about
You're breaking up a little bit, Nick.
Factor trading, places like H1, they trade the momentum factor, they trade the value factor. There's a lot of trading, and you hear about things like factor timing and factor rotation.
No, Nick has dropped.
Sorry about that. I don't know why I just lost connectivity there.
Yeah, you were breaking up there for a minute, Nick.
Okay.
Where did you gotten to?
So I was talking about factor trading. As I said, there's one large area of the industry, especially the area where they do what's typically called equities quant. As some of the largest quant funds out there, whether it's a BlackRock or an AQR, they trade factors, and we talk about the research into factors. Academics love factors, so they write research on it all the time. Factors are a bit like anomalies. Sometimes sometimes they'll appear in the literature and people will make money off them. Sometimes they will go away. We'll talk about the literature around verifying those factors, whether they're worth trading, and as well as the proliferation of factors, as well as how do you decide when you want to put them on. Then we'll be also talking about things like dimension reduction, which is very, very important in this very large, cross-sectional world, especially in the world of estimating covariance matrices. We'll talk about PCA, principal components analysis. We'll do it in particular, we'll do it for the yield curve, because that's something that's quite well understood. But PCA is done everywhere. And then we'll talk about regularization, because nowadays there's almost no models, whether they're machine learning or statistical models, that aren't done without regularization. Regularization was initially an alternative to model selection. Let's talk a little bit about model selection first. How one goes about doing it, whether it's sequential hypothesis testing, whether it's criteria like the AIC and BIC, but then whether it's things like model selection and double descent, whether it's regularization through L1 or L0, so ridge or lasso. Then finally, a slightly new area, we'll touch on double descent. And double descent is where regularization is thrown out the window, and instead we put in many more features than there are observations. And in that sense, the more features you put in, the more regularization you get out of it. It's a rather strange area. It's also called benign overfitting. We'll talk as well about adaptive filters, how one uses adaptive filters and why they're worthwhile in this case of non-stationarity. How things like exponentially weighted recursive least squares is actually a pretty big standard in some areas. And then we'll move on to the difference between forecasting and allocation. This is sort of a lead up, because what forecasting means and why it's not quite exactly the objective that we want, and that there's still another step left, and that's, I think, in the next week.
Sure. So week nine, then we sort of slightly different topic. We look at order execution and market making. So it's important to understand the role of market makers and how they operate, because obviously, even if you're in a fund, you're still going to be trading a lot with market makers, either directly or on the exchanges, etc. So a lot of the higher frequency liquidity providers are what we term market makers, and we need to understand the structure of the market. So in order to optimally place your orders and understand different order types and how kind of the prices come about and how order books work, the market makers are a critical component of that as well. And as I said at the very beginning, so algorithmic trading has grown in market making as well as everywhere else. So in fact, probably first kind of came to prominence maybe in some ways in market making, where the banks even 20, 30 years ago were starting to use algos to do some of their kind of e-trading on the smaller tickets, and then it kind of grew from there. So I've mentioned order types, and market impact's a big topic. So when you're testing a strategy, it's very tempting to go back, get a lot of data, run your algorithm, and just assume that you could have traded wherever the market was at each point in time. That can be okay if you're very small, but once you start getting into slightly bigger sizes, or once you start getting into less liquid markets, that's suddenly not justifiable. And there's a whole, area of research into modeling how trades impact the market. And understanding that is critical, and market making, again, kind of ties a lot of this topic together, really. How they operate, things like adverse selection, how they make markets, how they get paid for providing liquidity, etc. Do you want to go, Nick?
Okay, so week 10, this is what I was skipping to. Week 10 is how you fit forecasting models together, and initially we talked about asset allocation frameworks, whether it's CAPM or arbitrage pricing theory, and then as well the Fama-French model. Again, this is looking at factor-based trading, but then sort of the basis for it is mean variance optimization, and how one does the optimal portfolio theory, how it works and how diversification works. What happens in the case of two assets for diversification, in N assets, what you can do, how you optimize to get your Sharpe ratio, and things like was it called tactical asset allocation, putting forecasts together so that you can allocate across different assets, and then allocate across different assets with transaction cost awareness, whether it's trading at the top of the book, or whether it's trading with market impact, because there are different approaches to it and sort of different outcomes. And we'll talk sort of more about the practical nature, how one uses, how one goes about programming this. The quadratic programming optimization methods, whether it's in particular using CVX-Pi, and symbolic coding for doing that. Finally, we sort of take a step back and look at mean variance optimization as a form of regression, because what it does is it gives you sort of more ideas about, if you especially have very large portfolios, how do you make sure you have sparse portfolios? How do you make sure you have portfolios which don't have a whole lot of turnover? And sort of that, take a step back, how can you look at the whole thing in one go?
So then in week 11, we look at back testing and performance. So once you have a strategy or an algorithm that you think will work or believe will work for whatever reason, you need to have some way of demonstrating that, proving that, or at least going some way towards proving that. And the first thing we do is we set up some sort of back test where we run our algorithm over historic data, historic periods. We see how it performed, and we measure that performance using lots of potential different measures, such as things like Sharpe ratio, which I'm sure you've heard of, but there are many others such as Sortino, Omega, etc. So we discuss what all of them, what all of those are. Drawdowns are particular. They should be of concern to us as well, of course, but they're really a huge concern to investors. So particularly institutional investors are very keen to understand what is the range of likely down days, down months that the strategy may have. So they want to know what's kind of the worst case scenario, what could happen. So that's something, again, that we look at. And all of the above, and throughout the course, everything is done using Python, and we have example code for all of these things. And we'll show you how to use them, how to annualize the different measures. Again, might seem a little trivial, but you'd be surprised how often people mess it up or don't do it properly. So in order to compare like with like, a bit like in the interest rate world and fixed income, we annualize everything so that we can compare easily. Similarly here, you need to be comparing apples with apples when it comes to performance. What is a realistic backtest? And there's lots of things go into this. One of them, of course, is the market impact I mentioned earlier. So you've got to incorporate some form of transaction cost, something realistic, so that there's some hope that if you implement the strategy in real time going forward, that it will actually perform similarly. And all of these models, particularly those of the sort of more machine learning type variety, the more kind of data hungry methods, more complex methods, involve a lot of hyperparameters. Now, these are sort of a blessing and a curse in equal measure. So they allow a lot of flexibility to make a strategy work in a sense, but with that comes issues which again we look at, they're kind of statistical in nature, to do with overfitting and so on. But how you tune your parameters to get the best out of your model is a major topic. And then Nick will do week 12, the final week.
Yeah. So the final week is sort of something slightly outside the framework of the single model pipeline. As I said, we were talking specifically about signals, data all the way to execution. I guess you could say, to some extent, performance is a little bit outside the entire mandate, but as well risk management. Risk management is a separate topic, and risk management is something that we go into to describe how risk managers sort of approach risk management for not just linear products, but slightly more complex products, and how one puts it all together in sort of a concerted way, because it's a crucial issue, how you, not just how you scale your strategies, but how you cope with all these sorts of potential risk events, whether they're operational risk, which unfortunately is one of the biggest risk issues ever. Although it's the least sexy, it's not like market risk. Operational risk is probably the primary reason why funds go out of business. And risk management is something that I'd say starts not just with the risk manager, it starts with you. The portfolio manager himself has to have his risk management in place to make sure that he doesn't have a nasty knock on the door from the fund risk manager, the CRO, who wants to shut you down. So this is really going into some details on that. We'll also talk about, as I mentioned before, optimal scalings for strategies, some of the theoretical optimal scalings for strategy. What you might have heard of was Kelly betting, things like stop losses. These as well, they have a risk management side to them, because stop loss is a type of risk management structure. Whether it's a trailing stop or it's a stop from start, those are sorts of things that are very, very important for ensuring that a model that might go haywire doesn't kill you. Then we'll talk finally about value at risk, which is a market risk-based approach. So value at risk, what some of its challenges, but as well as things like expected shortfall and other sorts of features of good risk measures, and how one should go about doing risk management from a sensible point of view. As I say, I believe this is the last week, and I believe this is the last slide here in the syllabus. Oh no, it should be the last slide. Yep. So I think there one final thing that we'll touch on, because it's also very important from a risk point of view, is things like here we say specifically covariance estimation, covariance shrinkage. It's estimating large covariance matrices, which is a crucial issue for not just for it's really important in things like stats arb, but it's also very important for risk managers, and we'll talk about that. And so I say at that stage we would have touched very practically on a wide range of topics, all quant-based topics that we think are sort of practically important as something that all quant managers should know about to a good extent before launching their own quant careers, or for continuing them for that matter. Okay, Brian, maybe you should continue.
So what are the prerequisites then? So what do you need to have, or what's kind of desirable to have in order to attempt this course? So I guess first of all, we would say intermediate or experienced programmer. So we will be using Python, as that's so widespread nowadays, and relatively easy to learn and use and so on. There's lots of good libraries that are free and lots of good open source material. So if you're familiar with Python, that's you're off to a flying start in this course. You do need to be able to program in something, definitely, preferably Python, I would say. You will absolutely struggle if you have never programmed. and you're trying to learn through this program. Statistics or econometrics or machine learning or anything these are all kind of statistical topics. So I guess really what I'm saying, or what we're saying here, is statistics. So you need to be comfortable with statistical ideas. We will go over a lot of the basics again, or the relative basics again, but it's fast. And you do need to have that kind of comfort with the sort of ideas of inference and large numbers and central limit theorem and so on, because otherwise some of the material you will find tricky. Basic finance is surprisingly probably in terms of importance the least of these three. So surprises people maybe a little bit. There is jargon, and there's stuff, if you've no finance knowledge, which I think is unlikely, most people tend to have coming to this course, but assuming you have very little finance knowledge, I think you can still do okay if you can program and you understand statistics. The main issue is really around jargon and around how the different markets work, and kind of becoming familiar with what's an exchange and what's a bid and an ask, and all of that boring but important kind of jargon that gets used. So, the only thing that we kind of really use from economics, I guess, is some kind of a bit of rationality arguments we use here and there a bit, but arbitrage a little bit, but it's more kind of, we do touch on utility theory a little bit, but to be honest, utility theory is kind of common sense, I'm honest. I mean, you don't need to kind of get into it in too much detail. The economists love it, but yeah, we'll leave it to them. A plus, and again, this really is a plus. So, I think most people who've done the course have not had this. And, if you have it, it will allow you to really delve into some of the papers that we recommend a bit more and really understand them more thoroughly. The material in the lectures, I don't think you need this at all, really. Maybe one or two slides, but it's really more for the supplemental material, right? It's really if you want to get into a bit more of the detail in the models. Is that everything covered, Nick, on prerequisites, do you think?
I'd say so. I mean, in some sense, we're saying that these are things just to be, somewhat familiar with. The finance itself and the familiarity with economics is more, as you say, reasoning than it is. Neither of us is an economist, although sometimes, surprisingly, we could probably pass for them every now and again. But it's just using economic common sense in models.
Do you want to do the assessment, Nick?
Okay, so our assessment, we have one written assessment at the end, and it's a rather large project. That's where the students produce a PDF and or a Python notebook, a Colab notebook, describing a strategy in detail. And it's not necessarily your best strategy, but it is the type of strategy and the type of analysis which one would present to investors, to bosses, to whomever, to justify it, to justify the understanding of what's the behavior for the that you're trying to capture, what's the rationale for the strategy, how you implemented it, what performance measures you use on it, what sensible, and then how those performance measures have changed, what's the limitations of the strategy and the room for improvement, because no strategy itself is perfect, but there's but you can find, so students have gone to great lengths going in detailing strategies and how they perform and coming up with a very sensible way of going about doing things. So Mark says, for sensibility of coverage and exposition, following the methodology that we effectively lay out. So good performance. You don't have to have a 3+ Sharpe ratio to show a strategy. The strategy doesn't have to be a fantastic strategy. It has to be a well-justified strategy. And I think that's an important matter. Well-justified and well-explained. Okay. So finally, wrapping it up, I guess the takeaways, Do you want to go?
No, you should. You're on a roll, Nick.
Okay. Takeaways. So algorithm trading is a large and growing part of the financial services and financial markets, and increasingly, with the advent of, say, machine learning algorithms, it's only going to be a matter of time before they become more and more relevant. And what Brian and I do is keep abreast of new developments here and how one should take advantage of them. As an area of study, it's new. There are relatively few university courses. In fact, there are almost none, surprisingly, that put this all together. And focusing often some focus on the purely mathematical aspects. They neglect the analysis of risk or what risk to take. They don't look at the statistics of the sort of effectively the finance behind markets. So our approach, Algorithm Trading, a practitioner's guide, is aimed to give you the practical skills for getting started in this area by covering both the academic side and bridging that and the practical side.
That's it.
Okay. Well, I guess we should open up if there are any questions. I know we have.
Sorry, I should have had a question slide, but I don't know what happened to it.
Oh.
But please, come in with questions either on the chat or just shout or raise your hand or whatever you normally do.
So one of the things I should emphasize is that one of the things that we have in our course is that we have our weekly meetings. We go through in some detail discussing topics that are typically related to questions over the week, but they're not necessarily. And by the end of it, I'll tell you, by the end of the 12 weeks, sometimes Brian and I are a bit sad to see some of the students leave because we develop kind of rapport. I think that's an important matter because there's a lot of really interesting stuff to study out there. And people who've taken our course typically come with a lot of their own experience. Some not necessarily. We try to guide them along, but I think it's really important to that come to bear because I think everyone benefits from that.
Okay, there's a couple in the chat here. So Oliver might do the QDs as a quant developer course. Yeah, I mean they're quite different. They're complementary in some respects. Quant developer is a bit more focused on, a quant developer role is more focused on technology. It's obviously implementing quant models, but it's very much, they tend to be very good programmers. It's often C++, it's or C sharp, it's quite, high level programming oftentimes in the job itself, right? What the quant analyst or quant researcher does is a bit more mathematical, statistical, and a bit more, I want to say creative, but the quant developers wouldn't like that. But it is a bit more it's a bit more researchy. It's a bit more kind of playing with ideas, coming up with something that works, and it's less focused on plugging it into a big system that's used in a bank or an insurance company or even a large fund. So yeah, I mean, they're definitely both obviously, great courses, quite different. Which you should do in which order, I don't think it particularly matters.
Yeah. We're not going to focus so much because ours is a Python based because Python, the accessibility of Python. If you use C++, all the better for you. But we're not going to expect that from people because we're going to focus slightly more, not so much on the processing of trades and things like that, but on the statistical decisions that are basis for these things, the models that are the basis for them. So you could say a little bit more like data science approach to things in some sense.
So Harpreet left program a few years ago. I mean, it's difficult to say, Harpreet. We could have a conversation offline. I think it depends on how comfortable you would feel. You don't have to use Python. We will provide you with Python. If you, I don't know what you did before. I mean, within reason, you can use other languages.
When it's MATLAB,
Yeah,
R, things like that.
or the scripting languages are just easier from a development perspective because you can, you get this nice plotting and this nice tables. It's much easier than a compiled language. It's just always a bit trickier for developing strategies. They're more for implementing. So it's kind of not really possible to say whether you'll struggle or not. It really just depends on right now what you would be comfortable programming in, if anything. And the lecture structure, we don't actually touch on this, Nick, actually, which we should change.
Yeah, we should have changed.
The structure is that their lectures for the week are released on a Monday evening, London time, and they're all pre-recorded. You get all the slides, and you get Nick and I presenting said slides and also talking around them and adding in other things as well. We then have it's currently two, what we call engagement sessions. They're both on a Monday, and they will be focused on the previous week. So you'll have a week to look at the material and prepare questions if you like and join the session. The session is live with Nick and I. There's one in the morning in London. It's currently it's at midday, in fact. And the other is in the evening at 7. So again, subject to slight change depending on demand, but that's what we've done recently, and it's worked reasonably well.
The morning one is slightly geared towards those who join from Asia. Should be able to join the noon one. It may not be convenient for those from London, but it has been for some. And then the evening one is basically Europe and US.
And we haven't had that many. We've only really had, I think, one North American so far who actually tended to join the Asian session. Actually, the morning. Yep. He joined at 5 a.m. his time. So again, if we had 5, 6, 7 people in North America, we would happily cater to them with a class at an appropriate time. And the day of the week can change too. It doesn't have to be Monday. I mean, it's not absolutely set in stone. But that's the structure. So it's quite flexible and that's at your own pace, but it's a weekly cadence. And then after the 12 weeks, it's the assignment.
So the engagement sessions, we sometimes can go over an hour, but we try to make it at least one usually, and it is talking around areas that the students have interest in if they've read the lecture notes the week before. And it's going through those, and during that, of course, oftentimes we find that there are many readings that we've not yet divulged. And so we go through some of those.
Right.
We'll talk about, and that in the meantime we're compiling our wiki for the course that we'd like to release to everyone at the very end, just describing good reference materials for every topic. But there's some topics that there, to be fair, there's plenty of drilling down that's necessary. Sometimes sometimes we've been known to go off topic because various people really know their stuff and want to know and want to talk about algo trading in treasuries, algo trading in vol markets, things of that nature. So there can be oftentimes a pretty chatty session that we try to make sure that everyone contributes to. The programming, the Python and Jupyter is really for the final assessment, yes, although we'll give some example Python and Jupyter in the meantime. I think now with the, I'm a big user, so with the advent of large language models, there's plenty more Python we can generate on the way. And we'll talk about some of that because there's plenty one can do with those things. Ishwar had a question about
backtesting platforms. Yeah, I mean, we're obviously Nick and I are very aware that there are plenty of backtesting platforms out there, and we could spend the next hour talking about the relative merits and demerits of each, and they pop up all the time. We're not really proposing a platform as such here. We're proposing you build your own. So using Python or a similar kind of scripting interpreted language, you actually build your own backtesting framework. It's once you have the data and you've cleaned once it's easy to build a good one, but you can build something fit for purpose with a bit of effort. I think the backtesting platforms, to say briefly, they tend to obscure some of the details from you, particularly around the data, and you're never entirely sure whether your strategy is actually working, to be honest.
And some of them are overly optimized for specific sectors.
Yeah.
And I mean, they may be some have had beautiful, sort of beautiful output, but it only works for equities,
right.
Or I'm sorry, it only works for bar data. It doesn't work. What if you had tick data instead?
Yeah, so I mean, I think they're interesting. As Nick says, they look very nice. I think they have their place sometimes, but I would be very wary. I think if you're going to do this, if you really want to work in algo trading and you want to do it properly and understand what's going on, there's no substitute for doing it yourself.
There's always room, and I'm going to say there's because there's pros and cons to all those that are available. There's always room for another one. Because maybe there's maybe you'll be the one to invent the next best platform, and the most general could be somewhere. Well, I mean, Zipline, I'd say I liked bits of it, but it doesn't work for me, unfortunately. It has pretty graphs, that's for sure.
Yeah,
Zipline does.
Yeah. It's a popular framework. You Fed cut by half a point.
Oh wow, that's not what I would have expected.
No, likewise.
I thought they were going to pay. They weren't going to let the market dictate these things for them.
What happened to conservative Powell?
Yeah, exactly.
Oh well.
Oh, that is.
Sorry, guys. Relevant but slightly off topic.
Yeah.
So are there any what is the weekly workload? Well, to be entirely honest, the weekly workload obviously depends on how familiar you are with some of the material. I would, how long is a piece of string? Yeah, I think 2-3 hours a week minimum would be what I would say. Just to watch the videos and go through the lecture. That's at minimum. Any kind of additional, looking at some Python notebooks, playing around with some numbers yourself, reading some of the other material, obviously adds on. So it's not a huge burden, but some of the weeks in particular, so there's 3 or 4 weeks that have a lot of material. The first couple of weeks are fairly light, and then it ramps up to quite a lot of material. So again, there's no simple answer, unfortunately, but that's the best I can do. Oh, so Ishmael has completed the QDC, right? So, again, look, it depends on what you want to do. I mean, without going around in circles, but if you want to develop strategies, this is the course for you. If you want to work in a bank or a large institution writing really good quality code, then the QDC is for you.
I mean, there's a bit of a, I guess there's a bit of an overlap. If you want to work, we touch a little bit on high frequency. High frequency is of course an area where high quality code and these sorts of strategies come together effectively. Oh yeah, Prince. So thank you, Oliver. It says there was an error on one of the codes. Listen, how much time final assessment? Okay, final assessment. We have given 6 weeks typically. Was it 6 weeks? I think
2 months.
2 months. Okay, so 2 months is not necessarily enough for some people. We'd like to make sure that we want to encourage everyone to complete it because I think it's a really important thing, and it's actually I'm going to say it's not terribly dissimilar from our final project that we give at UCL. So it's I think it's a very good it's a very good undertaking, and I've seen some students who've done so well that they've basically published papers on it. You know, things that they can take around and show to their prospective employers and say, look, you know, I've written up a strategy. This is the kind of thing I can do. It's pretty easy for me, right? And you know, it depends an awful lot on your level, of course.
Yeah. So yeah, I mean, like as Nick said, we want everybody to have the opportunity to get the certificate, and you know, people have jobs and people have lives, and stuff gets in the way. So we've always accommodated that in the previous cohorts, and we will again. You know, Nick and I are not planning on going anywhere, so we're here. We can grade your assessment, you know, within reason when you're ready, and as long as you let us know. And that's it, really. You know, there's no, you know, the 2 month deadline is more, it's nearly more for you than for us. You know, to sort of give you something to work towards so that you don't just put it on the long finger forever. Because, you know, this is, we certainly believe a great course. So it's worth having that certificate at the end. Any final questions before we stop recording and wrap up? "30 years of marriage." Okay.
So Paolo, I'm not sure that you are. We may be older. You look like a young man there.
Well, I mean, just to give you a clue, Nick and I first met at Deutsche Bank over 20 years ago.
Okay, so Paolo, you might be a tiny, a slight edge. Okay, but there's still plenty of room to do this kind of stuff. One of the nice things about algo trading that's a little bit different from a lot of areas is that okay, there's pros and cons to working from home, but algo trading is one of the areas that you can work from home. It's you know, it depends on the firm, of course, but it's pretty straightforward. You can work remotely, you can work from home. It doesn't make a bit of difference as long as you can log on, and as long as you interact with people on a regular basis too.
Yeah. It's all, I mean, you know, depending obviously if you have a boss, if you're working in a structure, then it's different. But it often is something you can do kind of at your own pace a little bit. You know, it sort of lends itself a little bit to doing it. You know, when the inspiration strikes, you know, and you have an idea, you sit down, you test it, you play around with it. And so, you know, working from not necessarily from home, but not being a kind of a slave to a trading floor desk, I think actually does help a lot with this stuff. So I think it can be done anywhere, really.
Yeah, it is something also. So as Paolo brings up, this is algo trading is something you can do for yourself. And it depends on the size. There's some things there. Of course, there's some strategies which are out of the question you can't do. But but a lot of the strategies, a lot of algo trading as an area developed, as an industry developed, people trading their own books, and then growing that. So I'd say the oldest algo firms are ones that they're either Chicago prop shops, or they're like Renaissance Technology, initially trading very small bits of capital, and then growing that in a very sensible way.
No, there's no preference in terms of brokers or APIs. I mean, there's the common ones that people tend to use, and we do touch on them a little bit, but we're fairly agnostic. The issues are the same regardless of what you're using.
I mean, we're not going to. So we will talk about some of our preferred data sources, of course. When it talk, there are brokers is pretty easy to automate algo trades through. There's some you have to write in their own. I'm trying to remember the name of the language. There's specific languages, DSLs that you have to do to place trades in those. I think we'll stay neutral to that. So Anthony asks, does the program offer full knowledge capacity for quant devoted work independently as a freelancer? So for quant developers, typically quant developers have a fair amount of industry knowledge and know about finance and all the sort of the jargon. You're not put off by it. So this is an area where people with quant development background, of course, can put their work to good use, and understands how strategies are sort of devised and implemented. And so the only thing I don't know about is a freelancer, because I'd say that a lot of places you work as a lot of places in this industry, you work as part of a team, you work on a desk, you work in a pod, or just, you're an employee.
I don't know many freelance quant developers.
Yeah.
Lots of obviously independent traders and so on, but quant development tends to be more of a kind of a large institution thing. They're definitely contractors, so like your contract developers and everything. So there are a lot of the best quant developers are contractors, or certainly used to be. But I see you're asking a question.
Some contractors are very long-term contractors.
Yeah, you'll be working for, and a lot of it actually was for tax reasons as well. You would be working for a large bank or a large firm for long periods as a contractor, so rather than as a full-time employee. But I think it would be just unusual to be kind of a complete freelancer working in that particular role.
Yeah. So Anthony says, many profiles on Upwork. I'm not sure that's a way to sort of maximize pay. Is Upwork? Yeah. I mean, maybe they're 3 months, 6 months, but they like to lowball. That's for sure. And you don't want to work for 3 months on a really paltry salary. Please shed some light on the course fee. Well, Abdi, that's something that I'm afraid Jeff Jeff knows most about, because I know there's various different early birds and things like that. That's something he can talk to you about. We're somewhat independent. final question: where do we source market or price data? That's what we're going to talk about to some extent. There are new places all the time, and we're discovering some recommended by former students or prospective students even, and some of them that we surprisingly cheap places that give high quality data. And so we'll talk about that. We'll talk about some of our favorite. I don't know if we have a list, Brian. I mean, I know you and I have talked. Okay, we talked about Data Bento, but there's a whole bunch of other ones.
There's a lot of them out there. So that's a list we should put together to add to our many other lists.
Are you capable of building good algos? How much annual percent gains and volatility? Well, it depends a little bit on the time scale, and it's possible to build. It's not that hard. I'll tell you, it's not that hard to build a 2+ Sharpe ratio strategy. It's complicated, but getting above 3, you're going to have to work in sort of intraday data, and then you have to source it and have a way of getting not just the source the historical data, but have the data feed, as regular basis.
And scale tends to be an issue as well. So a lot of the event-based or strategies you see with 3-4 Sharpe ratios, they don't scale. They're fine for very small amounts, but relatively small amounts. But certainly, like a large institution, like a large fund, just has no interest because they can't deploy 100 million or whatever. So that's another issue.
So will we be touching the course on algo trading in Bitcoin and Ethereum or derivatives? Okay, so Bitcoin and Ethereum are certainly things that are done in an algo trading. I can't remember if it's a topic. I have a PhD student who now works in Bitcoin and Ethereum. I can't remember what they did at the time, or whether we actually. I think our papers were on crypto. He was doing FX at the time, and now he's doing crypto. He's doing crypto, mid to high frequency trading. A lot of the same things come up again and again. There's maybe some specifics of Bitcoin and Ethereum. It's a very sparsely, the limit order book is surprisingly sparse. I mean, there's that's why it jumps. Top of book is not representative of where you can actually place the trade. So there are some specifics about it. But we're not going to talk in any great detail about crypto unless you want to bring it out in the Monday meetings. Yeah, and one of the nice things about crypto is it's so easy to get data.
Yeah,
and I know quants who love crypto because they don't have to worry about macro risk. They don't have to worry about risk in general. It does its own thing. Everyone's it doesn't pay attention to the rest of the universe.
Allegedly.
Except when there's an inflation issue, or I don't know, when the Fed's gonna maybe it reacted to the Fed cut. We can see that.
What about deploying to cloud? Again, we don't get into some of the kind of more technology issues simply because we just don't have time. I mean, Nick and I have obviously deployed in cloud and on premises and everywhere else, but it's.
I guess sometimes a lot of cloud-based computing is based on I'm going to say great inefficiencies but it's not necessarily. So one of the nice things about putting in AWS or Azure is that you can have it running all the time and your home computer can turn off, and that's great. But a lot of cloud computing is also based on you can spin up however many machines you want to in a Kubernetes cluster, and a lot. I'm going to say a lot of that is based on the fact that everyone's using inefficient Python and doing it as parallel as possible. Whereas if you concentrate on slightly more efficient code, it needn't be in a whole cluster. But there's the core of the program is strategies for algorithm.
Yes.
Absolutely,
Yes.
that's exactly what we want to go into. We don't want to talk in a huge amount of detail about the systems. You can spend a whole lot of time on the computer science behind these things,
Right.
but we're more. Brian and I are both mathematicians, and so we're focused on the mathematical, the statistical aspects of them. Sure. So it's the unfortunate fact is you're going to have to program them and you have to be good at programming them. But we'd like to focus on the thing is there's a lot of detail to be said in the statistics of these traits.
I love genetic algorithms, and I do touch on them a little bit. We don't go into them in huge depth, but they are actually very useful for the kind of hyperparameter optimization bit, because of sort of nonlinearities and other funky things. So yes, we do a bit, not so much swarm algorithms, but yes, certainly genetic algorithms.
Yeah, my favorite hyperparameter optimization methods are, I guess you could say they're like either genetic or they're was it multi-arm bandit algos, which are there's a whole bunch of bandits that are searching out cinema, and then it's genetic because they can live or die at any point in time, and looking for this global optimum, exchanging information to look for the global optimum.
Yeah.
HMMs. So I can't remember whether we talk specifically about HMMs. I mean, I know we do talk about regime switching models.
Yeah.
And change point detection methods. And oftentimes one of the sort of the challenges of regime switching models is lots of times you'd love to be able to get a regime switching model to work, but I'd say for the most part they work better after the fact, ex post, than they do as a forecasting method. And it's documented that the most regime switching models don't work that well. Whereas a change point detector, which is, I'd say, you could say it's kind of a poor man's regime switching model, because a change point is where you forget the entire history after the change point. They tend to work better for forecasting. Oh, you know what? Okay, Powell's going live. Yeah. Okay. Well, anyway.
Is there any last questions before we stop recording and let you get on with your evenings? No. Okay, let's leave it there, guys. Thank you all very much for joining.
Yeah, thank you all very much.
Yeah.
Lots of good questions.
We hope to see many of you in the coming weeks.
Yeah.
And Jeff or similar will distribute the deck to you all.
Thank you, guys. Bye.
Okay.
Jeff,
Thank you very much, guys.
Do you have anything to say, Jeff? Are you done?
Oh, yeah, there's going to be a recording for this that's
Yeah.
made. I believe that Jeff will be able to distribute it. And as you said, of course, during the course, all the recordings are available.
Sure, I'll make sure that this is distributed to everyone. And thanks a lot, guys. Much appreciated. And thanks everyone for attending.
Thank you. Thank you.
Bye-bye.
Thank you.
Thanks all.
Okay.